price to book is the lie detector of Wall Street, says hedge fund manager Bill Ackman. This ratio compares a company's market value to its book value, exposing when markets overhype or undervalue assets. It's one of several essential financial ratios that give you a clear view of a business's true health beyond surface-level numbers. When you know how to interpret P/B ratios, you can spot undervalued opportunities during downturns and avoid inflated risks during booms. For example, a 0.5 P/B ratio has signaled 300% gains, while a 5.0 P/B has preceded 80% crashes. Understanding financial ratios like P/B, along with others we'll cover, sharpens your instincts and supports better decisions. But valuation is only one piece of the puzzle. Profitability can be just as revealing, especially when growth and risk don't always move together. If you're new here, please subscribe and like, because I share tips to help you improve your career. Profitability metrics like earnings per share, EPS, and the price-to-earnings, P/E, ratio are vital for understanding a company's true performance beyond surface-level growth figures. Take, for example, a tech startup that posts 50% annual revenue growth, but sees its stock price drop. This disconnect often occurs when investors focus on EPS, the actual profit assigned to each share, rather than just revenue. EPS strips away the noise, revealing whether a company's sales are translating into real profits. Consider a SaaS company spending $2 million each month to acquire customers, with its EPS sliding from 15 cents to minus 22 cents across 3 quarters. Even as subscribers doubled, each dollar of revenue cost $1.30 to generate. In contrast, established rivals kept their EPS above 50 cents by managing expenses carefully, resulting in steady stock price growth while the startup's valuation was cut in half. Expert Alina Ray emphasizes comparing EPS trends to those of industry peers. If your EPS lags behind competitors despite similar revenue, it's a signal to examine your cost structure, such as cost of goods sold and selling, general and administrative expenses. A consistent 10% gap in EPS growth can point to operational inefficiencies that demand attention. The P/E ratio builds on EPS by showing how much investors are willing to pay for each dollar of earnings. For instance, a P/E of 15 means the market values each $1 of earnings at $15. While high-growth tech firms might command P/E ratios above 30, numbers well above the sector average often indicate overvaluation. In 2021, several electric vehicle startups traded at P/E ratios over 80 despite negative EPS. When interest rates increased, these stocks lost 60 to 90% of their value. Tracking these ratios helps leaders recognize key warning signs: declining EPS despite revenue growth, P/E ratios rising faster than earnings, and widening EPS gaps compared to competitors. Some organizations use strict rules, such as requiring an operational audit if a division's EPS declines for 2 consecutive quarters relative to sector peers. This approach can uncover issues like a $20 million logistics inefficiency before it impacts annual results. Still, even strong profitability metrics can hide vulnerabilities if debt and liquidity risks go unchecked. To fully understand a company's financial health, you need to examine how leverage and short-term obligations affect its stability. If you're finding this helpful, please subscribe and like, because it helps us create content that matters to you. Also, if you want to take your skills further, check out our executive education and executive coaching programs at execbeat.com. When you examine a company's financial health, the reality of debt and liquidity comes into sharp focus. In 2017, a century-old retail chain filed for bankruptcy despite generating $1.2 billion in annual sales. 3 years before its collapse, its debt-to-equity ratio had climbed to 2.8, meaning it owed $2.80 for every $1 of shareholder equity. In contrast, competitors with ratios below 0.5 managed to maintain flexibility and withstand industry disruption. This example highlights why Warren Buffett prefers a debt-to-equity ratio under 0.8. It signals lower reliance on borrowed money and greater resilience. The debt-to-equity ratio shows how much of a company's growth is financed through debt versus owner capital. Take two manufacturers hit by supply chain disruptions. Company A, with a ratio of 0.5, could renegotiate payment terms and manage through volatility. Company B, at 2.5, faced immediate financial pressure when revenue dropped just 15%. As Shriram denotes, when debt servicing costs outpace returns generated from that debt, value erodes quickly through interest payments. Liquidity ratios provide another lens. The current ratio measures whether a company's current assets can cover its short-term liabilities. A ratio below 1.5 is a warning sign, and in a study of bankruptcies from 2015 to 2020, 83% of failed firms had current ratios under this threshold. Buffett's cash rule, holding more cash than total debt, proved valuable during the 2020 market crash, when companies with strong cash reserves avoided layoffs and emergency borrowing. Industry context matters. Utilities can operate safely with debt-to-equity ratios near 1.5 due to predictable cash flows, while tech firms risk underperformance if they cross 0.8. The interest coverage ratio, which measures how many times operating profit covers interest expenses, becomes crucial when rates rise. A ratio below 3 indicates heightened vulnerability. These ratios aren't just theoretical, they guide real decisions. For example, an agricultural equipment maker tracked these metrics quarterly and identified a 20% drop in its current ratio well before a downturn. By acting early, it converted inventory to cash through targeted discounts, avoiding forced liquidation later. Even with strong ratios, numbers can conceal problems if not viewed together. Understanding the interplay of debt, liquidity, and operational performance helps leaders anticipate risks before they become crises. When these metrics are monitored consistently, companies gain a measurable edge, especially when markets turn volatile. Studies show that organizations prioritizing regular financial ratio analysis tend to navigate economic uncertainty with greater confidence. The frequency of review should match your business environment. High growth or high volatility teams might track liquidity and leverage metrics monthly, while stable divisions can review them quarterly. This tailored approach ensures you spot shifts before they become problems. To make these insights actionable, open your next quarterly review with one key ratio, whether it's price to book or debt to equity, to spark focused, forward-looking discussion. This discipline separates proactive management from reacting to surprises. For executives, consistently evaluating these ratios turns financial data into a strategic tool, helping identify risks and opportunities before they appear in the bottom line. Thanks for watching. Please subscribe and like because it helps us bring you more free videos. And if you're ready to grow your career, visit execdeet.com to learn about our executive education and coaching.